What is going on, guys? Welcome back to another video. Today we're going to be going over whether or not now is the best time to get into the stock market. The market is at all-time highs, and the question is now the time to get into the market, or should we wait for a pullback? Now, of course, this isn't an easy question to answer. There's a lot of uncertainty in the market right now, and of course, hitting all-time highs like this, we don't know which direction the market will be going. So, of course, we have to take a look at the long-term potential, long-term future. Do we think that stocks will rise in the future, the long term, 5, 10, 20 years out? And the answer is most likely yes. We do. Stocks generally like to go up over the long term. Obviously, throughout the short term, it could go up and down, even flat. But most people are long term investors, most young people, and they're looking for the long term growth. So if you are looking to get into the stock market, I would say now is a great time to get started, regardless if we are at all time highs or not. So we can see SPY, which tracks the S&P 500, the top 500 companies in the U.S. And over the past year, it's been doing pretty well, up almost 50% in the past year. Of course, it doesn't always go straight up. It goes up and down. We always have some pullbacks once the market rises. And SPY being at pretty high levels, we can expect some minor pullbacks before continuing on an uptrend again. 5-year growth, pretty good as well, up 100%, which is doubling your money. Obviously, if you invested during the March crash, you would have doubled your money in about a year. But we cannot predict these things, and the best strategy to play the market is actually to dollar cost average, which means you're continuously buying in money at consistent intervals. So you're buying either at the lows or the highs, regardless of where the market's at. And then overall, it will average out. So averaging out your cost basis will seem like a straighter line. So SPY is a pretty good holding to get into the market. It's an ETF, so it diversifies your portfolio with a collection of stocks. And the great news is it pays a dividend of 1.5% every year. So it's a dividend paying stock, and if you reinvest the dividends back into this ETF, you can see some crazy compound interest over the long term. Now, if you want to invest in the S&P 500, my recommendation would not be SPY, but in fact, it would be BOO. And it has the same performance as SPY as we see, up 100% over the 5 years, and up almost 50% in the past year. So I recommend BOO. Not only is it a dividend paying ETF, it pays around the same dividend, but it's because it has a low expense ratio of 0.03%, whereas something like SPY has an expense ratio of 0.09%, almost 0.10%. And that expense ratio is basically the fee for investing in the ETF, investing in the collection of stocks, and you pay that to the fund managers. Now, these expense ratios aren't that high, but we do take note that SPY has an expense ratio of 3 times that of VOO, which is a bit higher. So if we take a look, the performance is the same, but you're saving a little bit of money on that expense ratio of 0.03%. Now, if you want to invest in something like VOO, or VTI rather, this is a great ETF, and I'm holding a ton of shares of this in my Vanguard portfolio. But we can see similar performance. It's done slightly better than the S&P 500, because it covers the entire stock market. And it covers not only the top 500 largest stocks, but it also covers small cap stocks as well, albeit a very small portion in small cap stocks, which is pretty minuscule, but it does cover those small cap startups. So we can see returns are pretty much the same as the S&P 500 indexes. So if you are interested in something like this, VTI is a good pick as well. It is a dividend paying. It has a slightly lower dividend yield than VTI and SPY, but you are making up for it with a little bit higher returns and capital gains to make up for that smaller dividend, since most smaller cap stocks do not pay dividends, and that is the reason behind that. And we can take a look. VTI also has a very low expense ratio of 0.3%. And as we can see, it has 3,600 stocks and covering the whole stock market as a whole. But the top 10 largest holdings are pretty much the same as the S&P 500 Vanguard ETF VOO. So you're not really missing out. You can't go wrong either with either ETF you choose. They're going to provide similar returns, invest in similar stocks. Just a very small portion into small cap stocks when you go the Vanguard Total Stock Market ETF route. So that's my take on the stock market. You can't predict where it's going, but if you're a long-term investor, we don't care about the noise that happens. We just care about consistently buying the dips, buying the highs, just dollar cost averaging whenever we can, and just invest as much money as we can for a long-term future. So that's about it for this video. If it helped you in any way, please leave a like and comment down below for any questions, any comments. And if you are new here, please consider subscribing. It really helps out the channel a lot. Thanks for watching.